Hi, I'm Wayne. This is Wayne's World Built by Real Estate. First thing we should really know is a little bit of the history, how our mortgage system works, how things happen. Well, 75, 80 years ago, we were like many other countries where we really did not have a mortgage system in our country. People would go to a local bank, a savings and loan or whatever, and they would take out money. They're going to buy our homes. I mean, average home price back then was, 10 grand, but people were only making 800,000, $1,500 a year. So it's still a large amount of money to them. Well, what would happen is the lender would lend them money, whatever it cost to buy the home. Most of the time, they would require the home buyer to have 50% down. So if you're buying a $10,000 house, you'd have to have $5,000. In today's dollars, that sounds really small, but back in the 1910s, 20s, even the early 30s, that was a lot of money to have at hand when people are making such small incomes. In addition to that, when they did lend you, it was an interest-only loan most of the time, and it had a 5-year note on it, meaning every 5 years you would refinance it, and you really never paid your loan off. An amortizing loan, which we have today, was not a commonplace item back in that time period. Home ownership levels were fairly low in regards to comparing them to today. Until the early 1930s, this system seemed to work. The banks had enough money to lend, and the borrowers were paying their interest, and the banks were satisfied. Well, when the 1930s hit, a lot of banks went defunct. There was a lot of banks that would not issue the new loan, which caused the people to go into foreclosure. There were a lot of borrowers that were out of work that couldn't make their mortgage payments. That also forced them into. By 1932 to 1936, 1 in 4 homes in America were in foreclosure, and another 15 to 25% of the loans were in default of one form or fashion because the borrowers were having a hard time making their mortgage payments. This really led to the Congress stepping in, part of the New Deal under Roosevelt, and creating a housing finance organization. It actually is the start of the Federal National Mortgage Association, which today we refer to as Fannie Mae. It was a federal agency, and they also came out with some new fully amortizing loans that would pay off over 20 or 30 years. This was really the start of what we call the FHA, the Federal Housing Administration, which was started in the late 1930s. It was around 1936. In 1938, Fannie Mae was brought into existence as a government agency. It was an outlet for the savings and loans and banks to sell FHA, VA loans to be able to have more money to lend out to someone else. It also gave a guarantee on those types of loans. The government agencies did. There was some inherent problems with it, and things changed over time. In the mid 1960s, there was some changes, and Fannie Mae was actually split into 2 sections. One became Housing and Urban Development. That's HUD, which is where FHA loans currently are guaranteed through and usually are bought by. Then there was the privately held, the part of Fannie Mae, or the Federal National Mortgage Association. That part was funded completely by private capital. It was set up so that lenders could lend out whatever the amount was that was needed. Back in that time, a reasonable house was $50,000, $60,000. People could borrow whatever they need to borrow. The bank could make the loan. They could turn around and sell it to Fannie Mae. Fannie Mae would either give them the cash for that loan for whatever the pricing was, and then the lender could in turn lend to someone else. So it made mortgage money more available throughout our country. Back in that time period, in some states, banking was limited to specific branches or specific counties. You didn't even have banking crossing county lines. Most banks did not cross state lines. So if you banked with a bank that had a branch in Kentucky and you lived over in Indiana or Ohio, you would not be able to make deposits across the state line from where your accounts were opened. So if you lived in one state but worked in another, it became a problem. Also became a problem when people would travel. They would use a bank that was located, say, in Maryland, but they would be over in Virginia. They couldn't do banking transactions. Until the 1980s, that was an issue. Well, that also made it more difficult for banks to lend money. In 1970, there was the Emergency Housing Finance Act, which actually is how the Federal National Mortgage Association was the first company, and the Federal Home Loan Mortgage Corporation, which is referred to as Freddie Mac, was started. It was set up as a private stockholder organization, which savings and loans would own the stock of Freddie Mac. Though they would also sell, anybody who wanted to sell loans to Freddie Mac at that time had to own stock in the company, and it was not a publicly traded company, but it was owned by private businesses. That stayed the same for Freddie Mac until the end of the 1980s, when it really became a truly privately held company, just like Fannie Mae was. The reason I bring this up is a lot of this background is these are the reasons why we have such a very fluid mortgage market in our country. It doesn't really matter where you live, whether you live in New York, Texas, Washington State, Hawaii, Guam, Puerto Rico. You can get a mortgage basically with the same guidelines. You can get a mortgage with the same as long as you meet the criteria for the mortgage. It's because this last 80 years in the development, there's been some hiccups, there's been some problems. There were a few years that when interest rates went very, very high in the 1980s, that Fannie Mae was losing $1 million a day because they had lent money long-term for 30 years at 3, 5, 6%, and they were having to borrow short term to carry that, which at the time was in double digits. It was 10, 12, 15, 18%. They were losing a ton of money. That's why at that time period, a thing called mortgage-backed securities came up. Mortgage-backed securities where Fannie Mae or Freddie Mac and also other institutions do it as well. They're just the two biggest ones that do it. Is they would group a number of loans. They'd have $1 billion worth of mortgage loans, and they may all have certain characteristics. They have a narrow rate of interest. They have similar maturity dates and other things. They get put together and they get sold into Wall Street as a mortgage-backed security, which anyone can invest in and buy in. It's a guarantee of principal, and you'll get your interest at each month, and then you'll get your principal as the loans pay off behind it. The combination of the cash purchases by these companies as well as the mortgage-backed securities really makes it so that our mortgage market can do well. When in the 2007-2008 debacle, when a lot of lenders were changing how they were making mortgages, they instead of using mortgage insurance, they were offering second mortgages. Appraisals were kind of by the wayside, and things got a little bit out of control. That was one of the reasons why Fannie Mae and Freddie Mac had good reserves. Federal government at that time did make it where the two companies had to have the banks buy back the loans that were faulty, so they ended up taking a lot of losses that they really shouldn't have taken. As a result, both of them were put under conservatorship, and they still are, as of 2021, still under conservatorship, even though they're both paid back many times what they borrowed from the federal government, and the excess funds are just going into the Treasury. This is where our state of our mortgage system is right now. Things are changing and moving forward. At the present time, we do have just the two real mortgage lenders. Again, they cannot make a mortgage, and they don't service mortgages. All they do is they're the conduit which makes the money available so that anybody in our country who's a citizen, and sometimes non-citizens, can take out a mortgage. And today it's unprecedented low rates. We're down in the 2-3% rates, and sometimes with a 15% mortgage or 15-year mortgage, you might even be under 2% in their interest rates today. Well, I hope this helps you out with learning and understanding how here in the United States, the mortgage business is so liquid and so easy to come by. There's many countries throughout the world that it's very, very difficult to borrow on real estate. You have to have a large down payment, or you have to have, connections with a bank or something. It's not at all the same as it is in the States. And it's one of the real benefits we have by what's evolved over the last 75, 80 years. Hope this has been interesting. Please give me your comments. I'd love to hear back. Any questions you might have, don't forget to subscribe. And again, send me your comments.